If you've been following the rates lately at all, you know they're higher than they were, which means you may have heard about something called an interest rate buydown, or the most popular one being the 2-to-1 buydown. In the most simple definition, a 2-to-1 buydown can provide homebuyers with the financial flexibility and affordability in their initial stages of their home mortgage, which can be especially beneficial for first-time homebuyers or those on a tight budget, but it doesn't come without some red tape. So a 2-to-1 buydown offers several advantages and disadvantages to homebuyers, and really here's how it works. So you start out with an initial lower rate. So a 2-to-1 buydown provides a reduced interest rate for the first 2 years of the mortgage. Specifically, interest rate drops of 2% in the first year and 1% in the second year. This means that homebuyers can benefit from lower monthly payments during this period, making home ownership a little bit more affordable in the short term. And then there's an upfront payment. So the borrowers pay an upfront fee in exchange for this temporary reduction in interest rate, typically paid in the form of seller concessions. This upfront payment allows the borrower to benefit from a lower interest rate in the early years of the mortgage, which can make the initial payments more manageable, but that upfront payment is a one-done deal, so once it's paid, that money is gone. So it allows you to ease into larger payments. So the reduction of the interest rate during the initial years can help homebuyers ease into the responsibilities of the mortgage, especially if they expect their income to increase in the coming years, or if it's predicted that interest rates will drop and be able to refinance into that lower rate. And finally, it provides some financial flexibility. So the initial savings on the interest can be utilized by the homebuyer for other purposes, such as furnishing the house, paying off other debts, or building up an emergency fund. So when applying for a 2-to-1 mortgage, borrowers have to qualify based on their higher permanent rate rather than the temporary reduced rate during the first 2 years. This ensures that the borrower will be able to afford the mortgage payments once the temporary rate reduction expires and the interest rate rises to the regular permanent rate. So while the 2-to-1 buydown offers temporary relief with a lower interest rate in the initial years, it's essential to understand the upfront cost to get that savings, which typically doesn't make as much sense when you start looking at it objectively. This also doesn't take away from the fact that it's really just a temporary relief and the higher payments will still be on the horizon. And you might often hear that these loans allow borrowers to qualify for a larger mortgage, and that's really misleading if taken out of context, because the borrowers can potentially afford a more expensive home due to the temporary reduction in the payments, but they still have to demonstrate their ability to qualify for the mortgage at the higher regular interest rate. I hope that cleared up the 2-to-1 buydown.